Hey, thank you so much for having me this evening. Just a quick disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational and demonstration purposes only. Right Line takes no responsibility for losses in the futures, forex, or stock markets. And we obviously caution that risk with trading is substantial, and it should be understood that a person can lose a substantial amount of money. Therefore, be ultra careful. Careful consideration. Your financial position should be made prior to trading. Never risk more than 2% of your account on any trade. Do your own due diligence. Consult a financial advisor. And Right Line Trading, we are not registered financial advisors. We are not licensed commodity trading advisors, and you may want to consider talking to one before making a trade. And with that said, what I'd like to do, just a little bit about myself. I'm a former professor at Jefferson Medical College, and I have an extensive background in finance. And what I really wanted to talk to you today is about the oscillator. Now, the oscillator, I think, is an extremely misunderstood indicator. And over time, because of the way the markets have changed, its use has also changed. Now, George Lane created the oscillator back in the 1950s. And what I believe he created was stochastic. And it really was an amazing tool when he created it. And George Lane, I did a lot of reading about George Lane and about his life. He was really a brilliant guy. It's interesting to note that he died poor, but he was a real smart man who came out with a lot of other mathematical derivations. Now, before him, the only indicator that was present was a MACD. Now, the thing that both of these indicators have in common is that they are second order derivations. And what they do is they measure the rate of change of a specific metric. And what they both do is they measure momentum. And momentum is a second order derivation. So what they're doing is they're looking at the speed of change of price. And I'm going to go into that more. But his postulate was that anytime you're looking at a second order derivation or the rate of change of some parameter, it had forward looking ability. So it would change before price did. So his major thesis was that the stochastic oscillator could be used to foreshadow reversals when the indicator revealed bullish or bearish divergences. He did not use this as a tool to trade the trend. He used it as a method for trading divergences. And it was really one of the first, and I believe the most important trading signal identified, and that was divergence. Now let's talk about it just a little bit more. Now, momentum measures the rate of change of a security or financial instrument's price. As the price of a security rises, momentum will increase as long as the rate of rise continues to go up. The faster the security rises, the greater the period over period price change, the larger the increase in momentum. So if a security is moving up at a constant rate, momentum is not going to increase. It has to move up in price in a geometric fashion, not an arithmetic fashion. And once this rise begins to slow, even if the price is continuing to rise, momentum will also slow. And as a security begins to trade flat, momentum will start to actually decline. Now, let's look at, if we look at the oscillator calculation, we'll get a little bit of insight into it. And there's only 5 parameters that are present on any given chart. Now, the assessment of volume has become very complex. There's volume ladder, there's market profile, there's all kinds of ways of looking at volume, but there are really only 5 metrics. There's the open, there's the close, high and low of every candle formation, and then there's volume. And those 5 metrics can be placed into different formulas, different indicators, which mathematically create a line based on those 5 parameters are cranked out. And what the oscillator looks at, now if you look at the formula, C is the most recent closing price. Now L14 is the average low of the 14 previous trading sessions or candles. H14 is the average high of the last 14 periods. So the percent K, which is the key metric or momentum metric, is based on how C closes. Now if C, which is the closing price, continues to approach the high of the move on a long trade, momentum is rising. If the close of the candle continues to approach the low of a candle on a down trade, then momentum is increasing to the downside, and the percent K line will fall or it will rise. Even if the price of the stock or the future or the Forex pair continues to rise, if the close starts to back off from the high, on a long trade, momentum is going to start to turn. So again, in a market trending upward, prices are going to close near the high. And in a market trending downward, price is going to close near the low. And that's what creates the percent K. And the big signal is when the percent K simply crosses the 3-period moving average of percent K, which is percent D. Now, what George Lane was looking for back in the 1950s and 1960s was divergence. And that's when price made an equal high or a higher high, but it made it on lower momentum. So although price approached the high of the previous move, the close of the candles did not get as close to the high of the candle as it did previously, signaling a drop in momentum and a likely collapse in price. This is all that George Lane was looking for. He was looking for a divergence signal. And here's the same example I took off of our charts. And here's price making a higher high. Now here's stochastic making an equal high, which is also divergence. And it heralds a collapse in price. The problem is that lately, and when I say lately, we're talking about the last 5 to 10 years, divergence has become a very, very iffy signal. Now, when George Lane first postulated it, I don't have data going back into the late 50s and early 60s. My guess was that it was a very, very successful signal, and that divergence worked a significant period of the time. If you do an analysis of divergence now, you'll find that it's going to call some tops and it's going to call some bottoms. But if you try to trade it on falling momentum, it's really, really going to beat you up. You're going to see, as I proceed with the talk, and I want to keep track of the time very, very, very closely, is that and I'm trying to make sure I know how much time I got left, is that the market has a completely different paradigm now. Now, this is another divergence failure. You can see that price is making a lower, stochastic is making a lower high here. And here's the higher high. But if you traded it, you would get a little bit of a fall, and you see that the market price just continues to rise right back to its previous high. No real collapse. And I could have shown you a much better example, but I want you to see that over time, the divergence signal doesn't really carry the strength that it used to carry. Now, in trading, here's how we would like stochastic to work. Every time we get a cross of the %K line across the 80 line, which is the overbought line, price is going to fall. Every time we get a cross above the 20 line, we get a long signal. We get another long signal here. It's just blocked. This is just charts by TradingView. I just took this right off the internet. There's nothing special about this chart. Get a cross here of the %K on the 20 line, you go long. You get a drop across the 80 line, you go short. And here is a drop across the 80 line, short and long. The perfect way for stochastic to behave. And here is simply what this simply demonstrates is that overbought doesn't always mean overbought anymore. And that when you look at the price of a financial instrument and you look at the stochastic as it crosses the 80 line to the upside, 20 years ago, traders used to look to fade the price of the market and go short. If you do that now, you're going to have a tremendous problem. And here, I think, is what's happening. And here's why. You have to use oscillators differently. And we've taken all of that into consideration when we created our modified Laguerre. Our modified Laguerre is not created to track divergence. It is created to take a forward-looking approach to the trend and in an attempt to trace out the footprint of big money. George Lane's indicator and all the subsequent stochastic derivatives like Williams K, like RSI, were all meant to look at divergence. We've created the first indicator to pretty much ignore divergence and look simply at tracking the trend and getting in at the most opportune time. Now, again, when oscillators were developed, there was little institutional volume in the market, and that's really the key. Now, the key is if the power of each buyer was approximately equal to the power of each seller, then a divergence signal was really, really a good signal. If momentum was falling and price was making an equal or higher high, since there was equal power on the buy-sell side, then likely the power of the buyers on a long move had waned and price was going to fall. Same thing on a short move. The problem is that now institutional volume and money dominates the market, and that's what determines the direction of price. Now, this is the same reason why Japanese candlestick formations, which 15 years ago were extremely powerful, have lost a lot of their value. It's simply because when institutional money steps in, it skews the market. And I'm going to take that even a step further. The natural harmonic of the market, as traced out by Gann theory and Elliott wave theory, are also obliterated simply because institutional volume is becoming a larger and larger percentage of total volume. So if that's the case, we have to change the way we think about these indicators and change our mindset and understand that the small guy is no longer in control. And with that, we have to trade these indicators a lot differently. Now, here's really the rules I would set out on how to trade an indicator like this. There's no such thing as overbought or oversold now. This is now a fallacy. The market is overbought when the institutional traders say it's overbought. They can, I mean, we trade crude oil and the NASDAQ every morning in the live trading room. And this morning, we got 3 trades on the NASDAQ, one for 9 points, one for 8.25 points, and one for 6.25 points. Those are the only 3 trades I took. There's no such thing as overbought or oversold. The market is going to keep going long or short as long as the institutional money is there pushing it down or up. And markets are going to reverse at the whim of institutional money only. It's not going to reverse on the basis of a divergence signal. Divergence worked great 20 years ago. It is not going to work anymore. Occasionally, you're going to get it to work, but the vast majority of times it's going to fail, and that's not an indicator you can trade profitably. Now, reversion to the mean is still a strong force, but again, that concept has been skewed, and price will revert to the mean when the institutional traders stand aside. Price is going to come back to the mean. So trading divergence is tantamount to trading against the flow of institutional money. And the only thing that we can do is trade in the direction of money flow. Whoops. So which indicator most accurately assesses buying and selling pressure, completely ignoring any potential divergence signal? Well, it's one that's been tailored specifically to do that. So with it, you're following the footprint of big money. That's all an indicator can do now. And it has to do it with incredible precision. So here's the easy language code of the Laguerre. Now, the Laguerre is it has a tremendous ability to be modified. It has a gamma, which determines its sensitivity and specificity, and also has multiple filters that can be used. So our Laguerre is proprietary. We've set a specific gamma based on a 1 year, actually forward-looking assessment where we do a year of market replay data. And we've set these filters to provide us with the best trade-off between sensitivity and specificity. And now, if we look at the Laguerre, what we're going to do is we're going to look to trade in the direction of institutional money. Now, there's very few rules we have to employ when we trade. One is we only go short below the 50 and only go long above the 50. I mean, it's my thesis, and I believe it to be accurate, that when the market is above the 50, the bulls are in control. When it's below the 50, the bears are in control. If you want to take a long trade below the 50, it's a counter trend trade by our definition. You want to trade short below, and you want to trade long above. Now, here's the Laguerre signal. And the Laguerre signal flashes an arrow on your chart right here. And that's the Laguerre line crossing below the 80 line, telling you to go short right here. Now, when you get to oversold, all the other indicators, all the other oscillators are looking to fade the market. We created a very smooth analysis, and we get this oscillator bar, or Laguerre bar, shows that the Laguerre is locked short. and it tells you that the only direction you can trade is short. Now, back 20 years ago, this would tell you you're looking for divergence and a move to the upside. What it tells us is that the institutional money is firmly in control of the market. The oscillator crossed below the 20 line here. Your entry is here. It locks down here, and the only direction you can trade is short. Now you get the same move here, but it's a counter trend move, and we don't trade it. We get the same trade here, short. The cross of the Laguerre line with the oscillate with the 80 line, you go short. The Laguerre locks down, and you get a nice short trade. I mean, that's what the Laguerre is looking to do. You can trade it short here and trade it short here. I'm sorry, these are long counter trend signals. Here's another example. Now I want to compare it to other indicators. Now the bottom indicator here is stochastic. Now here's our Laguerre entry short. Now you get in here with stochastic, right here on the cross of the 80 line. The %K line crosses the signal line, and you're in. But it's meant to track divergence. So it quickly, these two candles push it right above the 20 line, which is a signal to exit the trade. So you're out of the trade after a very small move. But look at the Laguerre line. It's locked short and allows you to take this trade all the way to the bottom, because we're looking to track the direction of institutional money and track money flow. And you can see the terrific short trade. Got a little bit of movement on the Laguerre, but not nearly enough to take us out of the trade. We also have here, this is called fractal energy, and it's also an optimized parameter that gives us some idea of volatility. When this yellow line rises, the potential move on an entry is long. And you can see how the yellow line rose into this short signal. It tells you that the probability of getting a long move here is good. So you want to see that yellow line rise into your entry. Now, here's another example, and here is the Laguerre modified against RSI. Now, in this entire move, there was not one single RSI entry. If anything was used to track divergence, and now the RSI is a modified stochastic by definition. If you look at the formula, it just does not work for me, and it doesn't work here. Here's your long signal above the 50, and up you go. Here is your long signal. Market's locked long. You can take any retracement long, and up you go. So you get two perfect entries here and here, both in the direction of the trend and in the direction of institutional money. When we see the Laguerre lock long, we don't look for a counter trend trade. We look to go long on any small retracement back to support. And you'll notice here is RSI divergence. And if you took divergence on the RSI, you would be taking a counter trend trade against the flow of institutional money, gotten completely beat up and knocked out of the trade, while the Laguerre would have taken us right in and run you over and taken out all your stops. Now, I'm getting really close to the end here. So I'm going to have to skip a lot of slides. This is the last slide I'm going to show you. Here's another long entry on the Laguerre. Now, the long entry on and this is Williams %K, comes a little earlier. But as you move up, the Laguerre locks long. and keeps you in the trade. But look what happens to the Williams. It falls below the 80 line. You're out. Falls below the 80 line. You're out. Finally, you get a move out, but the Laguerre locks long, tracking the flow of institutional money, and keeps you in this trade all the way. You're out on this down candle, where finally the Laguerre breaks short on this below the 80 line. You're out of this trade real early on Williams K. Now, I wanted to go to the live charts. I don't have time. We're at www.rightlinetrading.com, info at Rightline Trading. Our number 786-713-5276. The Laguerre is an essential component of our trading analysis. We only trade in the direction of institutional money. Now, here is our offer. This is the webinar special. Now, normally the Laguerre is $6.99. We're giving it for $2.99 on a lifetime license with free updates. What our next update is we're going to turn it into a multi-time frame analysis. You're going to get that for free. The buy link is at www.rightlinetrading.com/modified Laguerre. And the first 10 get a month in my trading room. And we make money almost every day. We're only on Tuesday, but we're up a lot of money already this week. And we trade the NASDAQ and we trade crude. Now, Rory's at the phone on 713-5276. Now, that's it. I mean, I have a lot more information, but I'm obviously at 7:50. So I have to end. If I can answer a couple of questions would be great. And I'm going to end here, though. I think I've used my 40 minutes. Hello?
Hey guys, if you got any questions here, we'll finish up with these questions.
Have I gone 40 minutes? I'm so bad with the clock.
30 minutes, but so I mean, if you got another 7 or 8 minutes worth of information, you're welcome.
I do.
Yeah,
let me
read the questions here too. So
okay, let me show you a live chart. And this is a live chart. It's complicated, but it compares all three indicators: the Laguerre, stochastic, RSI, and Williams R in this case. And it looks at entries and exits. And let's take an entry. Here's a good one right here. Now here's a long trade on the Laguerre. You can see the signal long. The 50 is green, the 15 is green. We're trading above the 50. We get an up candle. I mean, we get a break of the 20 line to the upside. Now the stochastic line gave us an entry a little bit earlier. And in this particular case, it's going to take us out at about the same time. RSI is going to take us out earlier, and Williams R is going to take us out much earlier. Once we lock long on the Laguerre, we're going to continue to ride this trade long. This single candle pullback, we're simply going to stay in the trade. Now here's a short entry right here. Now you can see you get a move down across. Now you can see that the fractal energy line has come way up, anticipating a really nice long move, or short move in this case. Get the down signal right here. Now you're already in the trade early on stochastic. You're in a couple of candles early. But look what happens with the top line stochastic. You're right out of the trade on these three up candles and gone. So you got a minute piece of this down move. RSI never gave us an entry. Williams R gave us an entry and then took us right out, where the Laguerre dropped and then locked short throughout this entire move, giving us the whole move to the downside and not taking us out till we get this up arrow. So we were able to take this trade on Williams, on the Laguerre, from the entry here all the way to the arrow here, where every other signal took us out here or took us out here. This is because this is formatted differently, and the code inside the indicator is differently. It's a great entry tool, and it keeps you in the trade for a significantly longer period of time. Now I'm looking at crude. I could show you any instrument. And I think what I want to make it clear is that this works on any time frame and on any type of candle. It makes no difference at all. Now look at this short move right here. This is at 10 a.m. You get a perfect entry on the Laguerre. You get no entry on stochastic. You cross over, but you're way below the 80 line. So this move is not coming from an over bought position. You get no signal on RSI, and you get no signal at all on Williams R. The only oscillator that gives you a short is the Laguerre. And then it locks short here, gives you this entire move to the downside, and you're out on this arrow right here. If you were trading any other oscillator, you would not have gotten in and been able to ride this trade all the way down. And like, again, that's because they're formatted to look for divergence, not to create a smooth pattern when money flow is just crushing price to the downside. It's a completely different type of analysis. Now here's another, I could do this, here's another one right here. Now this one is going to take you out because you get the up arrow. You're in here and you're going to be out on that up arrow. But you're going to be out sooner on every other indicator. We don't take counter trend, and we don't trade short above the 50. We have to wait for a signal to adhere to our rules. Here's a short trade. Stochastic, no entry. Look right here. And this is the last one I'm going to show. And then I'm right here. Now, here's the 20 line. So you do get a short signal right here. But it's going to take you out here. This is not a bad signal on the stochastic. The problem is it never locks down. And that's what you want to see. You want to see eventually this lock down here. And the exit out of the trade is a lot faster. You get no signal on RSI. And you do get a short signal on the Williams R, and here you get a pretty good exit too. This one, pretty comparable. But most of these trades are going to get you in better and keep you in the trade longer if you trade a signal off the Laguerre. And I could do this on any time frame and on any financial instrument you want. This is time frame independent and instrument independent. So again, so here I'm going to stop. That's a live chart. And the only thing I'll do is, well, I'm not going to show you the E-mini. I just don't have the time. On the NASDAQ. But we took 3 great trades on the NASDAQ. All of them long, with the Laguerre locked long. They kept us in the trade for 9 points, 8 and a quarter, or 8.5, and for 6 1/4. Great trades, and that was all we traded, those 3 NASDAQ trades.